Here we will explore the interactions between fiscal and monetary policies in the American economy. As we have learned, fiscal legislation passed by Congress can affect change in the American economy for better or for worse. Largely based on Keynesian theories of fiscal strategy, the government can pursue expansionary or contractionary policies to regulate aggregate demand, also known as GDP. In times of inflation, the government can restrict real GDP by decreasing spending or raising taxes, which have different multiplying effects on the growth of aggregate demand. The spending multiplier is greater than the tax multiplier, so a decrease in government spending will have a greater contractive effect on aggregate demand. In times of recession, the government can boost real GDP by pursuing the opposite policies, increasing spending and or lowering taxes. Increasing spending temporarily creates jobs and stimulates the economy, and tax cuts encourage consumer spending and investment. Given these tools and relatively simple-looking scenarios, the government appears indefatigable in the face of economic hardship. Unfortunately, this is hardly the case, even in an impossible universe where Congress is decisive enough to efficiently deal with a large organic macroeconomy in real time. Let's go back to our simple recessionary gap. GDP is down, so the government pursues an expansionary policy to inflate aggregate demand and increase employment. Then, inexplicably, the aggregate demand starts to slide back down into recession. To understand why this is happening, we must look at what's going on in the market for loanable funds. Once the government stimulus program brought the economy back to full capacity, the government's funds began competing with private loanable funds. This caused interest rates to rise, raising the demand for money in the market, which in turn discouraged private investment, counteracting the stimulus and lowering GDP. This process is called crowding out, because the government stimulus is crowding private funds out of the market and discouraging investors. This is why another policy-making entity exists autonomous of the legislative body, the Federal Reserve. The Fed is a quasi-governmental bank agency that specifically monitors and controls the amount of money available to the American economy. When the Fed makes such a decision, it's called monetary policy, as opposed to Congress's fiscal policy. It's important to note that the institution with direct control over the supply of money in the economy has much more indirect control over the loanable funds market. Therefore, whatever Congress accidentally does to the loanable funds market, the Federal Reserve Bank can decide to correct. In the case of our crowded out recession, the Fed could buy securities on the open market in what's called an easy money policy to increase the supply of money in the economy. This would mirror an increase in private loanable funds, which would drive down interest rates and reinflate GDP.